In this episode, Mike and I dive deep into the world of real estate investment partnerships. From avoiding common pitfalls to building a strong and effective partnership team, this conversation is filled with valuable insights and practical advice for investors of all levels. So be sure to stay until the end where we go over managing conflicts that may arise within partnerships. Mike, can you tell us a little bit about your background and how you got started in real estate investing?
Oh, perfect. Great question. And thanks again for the opportunity, El Rey. This is always good to connect with your guests. I appreciate this. So I've kind of shared this story in past and stuff. And so for me, I'm very similar to maybe a lot of other investors. You know, they maybe want to improve their financial situation. They're maybe not happy with the returns they're getting from their investments, be it from mutual funds and stocks. And they're just looking for something a little bit different. And so I was no different than anybody else. It was kind of the same process, same premise. And the one thing that always did well for me was when I owned my personal property, I saw what the opportunity was. The values increased quite drastically. And I started looking at maybe an opportunity where I can invest in maybe more real estate than in mutual funds and stocks. And back then, when I started almost over 22 years ago, now it's a long time, there was just not a lot of information. There was no podcast back then. There was no Facebook. There's no Instagram. There was none of that stuff. So we're kind of trying to figure this stuff kind of blind. And so did a little bit of reading, trying to understand it, talking to lots of different individuals. And I started buying property. So I bought my first townhouse, believe it or not, in Edmonton, a completely different market, back in 2001. And when I started doing that, I bought a property, just a simple townhouse. And I saw it as an opportunity. I was losing $40 a month of cash flow every single month. And I didn't think it was such a big deal. I'm like, $40, what's $40? And, you know, that's just one lunch I'm just not going to have every single month. So with that being said, I saw that and I saw the tenants paying the rents and it was all really great. Everything was looking wonderful. But then the following year, which was quite interesting, we raised the rents quite drastically. The market really started to take off. And instead of that negative $40 a month cash flow, it became quite a significant amount of positive cash flow. And so it wasn't money coming out of my pocket, it was now money coming into my pocket. And that was kind of my first aha moment into real estate. And I'm like, wait a minute, if I do a bunch more of this, I can create kind of like a business model out of this. I can actually maybe start to do this as a job. I don't have to work at the job that I wasn't really super happy at back then. And so that's kind of where I started to go. I started buying a few properties from that point. I was able to, just like everybody that's done this, you know, got a line of credit from my home, had all this debt equity sitting there, repurposing that, purchasing it for acquisitions and for property. And that's kind of how I started. And then it's kind of snowballed from there where people were interested in wanting to partner with me and then it became joint venture partners. And then from that point forward, it just started to kind of grow into kind of its own business. And that was really the beginning of my journey. And so been doing this for a little over 22 years. We've got properties literally all over the country focused on single family and both multifamily. And a lot of our acquisitions are done using other people's money. And so that's been kind of my claim to fame. And it's just been the thing that's worked very, very well for me. But what I really learned through this whole process and this journey is being able to get a little bit of my life back because I wasn't so strained in regards to my job. I can now treat this as a business and spend more time with my kids and my family. And that was really some of the big driving factors and why I got started in the first place. So, yeah.
I love that background. And I think it ties in well with what we're speaking today because you started out on your own and eventually you had to progress to partnerships, right? I ran into at an event recently where you spoke about raising capital. And I think that's a sticky point for many investors. They eventually get to that stage where it's raising capital, finding partners to help with holding mortgages. Would you mind diving into some of the benefits of investing in real estate partnerships?
Yeah. So I guess some of the benefits, there's so many that you can, plenty, right? And so some of the big benefits for my experience, and I would imagine for a lot of people, there's a few things. So number one, when I started looking at partnerships, my bank was starting to kind of cap me out. And so they were just pretty much saying, Mike, you know what? I know you got more more money, but we only allow you to own 4 or 5 or 6 properties. And once that's it, you've hit cap and you're kind of done. And even though you have more capital, they start to look at your debt service, and everybody gets to this stage. Like it's just a natural process of scaling your real estate business. So by banks telling me no, I got frustrated, and I'm like, you know what? I don't want to stop. I really like what I'm doing. I see this as a huge benefit, and you're telling me no. And so with that being said, this is where the opportunities, when you're able to bring in capital from other people and utilize some of their resources to really truly help you scale. So some of the benefits, number one, is it's obviously not impacting your debt service any longer because you are now partnering with somebody else that's qualifying for a mortgage. They're providing you the capital to also fund the deal. That means you don't have to come up with your own personal money. And that's a huge thing because you can really start to grow. You know, for a lot of us that are trying to grow this business, there's this kind of assumption. It's just like, I've spent all my money. I just need to raise more money to buy my next deal. Well, that could take a year, 2 years, 3 years to have enough for a next down payment. But that shouldn't stop you where you can actually utilize other people's capital to help you fund your next deal. And now you're a percentage owner of this deal and you're using your systems and everything like that that's in place. So again, really some of the three biggest ones is obviously, you know, once you get into a position where the banks are starting to kind of tap you out and say, you can't fund any more deals, you can utilize other people's capital where you are using their resources, you're utilizing their credit, their debt service to help you qualify. But the biggest one is it can help you expedite your scaling of your business quite drastically. You know, when I started to kind of figure this capital raising thing out many years ago, it all kind of like this big aha moment. And it was just like, oh my goodness, look what I can do. And there was a stage back in 2000, and I think it was around 2009, just after the recession, we were at full acquisition mode and we were closing 2 to 3 properties a month. And we were doing this pretty hard, almost 2 years solid. We were just buying and buying and buying, and we were able to raise a lot of capital to kind of facilitate that. But that was really the power of being able to learn how to raise money. And once you figure that out, the world becomes your oyster. You can do much bigger deals. That's another aspect, another benefit when you're raising capital is you're pulling some of this capital together to be buying bigger projects. You can still stay with smaller projects. But once you learn how to raise money and understand and get to the mindset of what the money partners are looking for from you as a real estate investor, again, you can do anything. It doesn't even have to be just real estate. It can be other businesses. It can be all sorts of different things. So the benefit of using other people's capital and learning how to raise money can really exponentially increase your growth just because you have such a significant pool of money to utilize for other future deals, smaller or bigger.
Now, we've highlighted the benefits because there's a lot of benefits to it, and it's sort of like a no-brainer. But I feel it's good to set people's expectations going in. What are some of the challenges that investors may face when partnering up?
For sure. And there's always the pros to the cons, and it's important to understand both sides of this. And I guess some of the biggest the biggest one that you tend to face is you got to understand you can make your own decision doing it yourself. This is your responsibility. You know, you can mitigate, you know, this is your risk and everything from that end. But one of the things that once you start working with a potential money partner, you have a true responsibility to that person's money. They've entrusted you to fulfill what you've committed to with them in regards to proper management, communication, all of those things, right? And so together it's supposed to create a win-win scenario. So as a real estate investor, when you are only buying 1 or 2 properties, yes, it's a kind of a business. And I say it kind of in a gentle way, kind of a business, because it is a business, but it is your business. But as soon as you start bringing in partners, your responsibility level goes significantly higher because you have a responsibility to constantly be in communication with your partner. So you have to truly treat this as a business and understand that that's what you're doing. And the second part that is one of some of the other issues is you also got to understand now you are also needing somebody else's involvement. That means not just communication side of things, you're also dealing with different personalities. And sometimes they are good and sometimes not so good. And so you have to also understand and be respectable that Some people may have a difference of opinion of what you are doing, and they may challenge you as a money partner as well. And so you have to be prepared for that. And that can be a little bit of a challenge when you've not selected the right money partner. I see this a lot out there on social media. People are buying properties, but they've not taken the time to screen their money partners to making sure that they're the right fit. So by not picking the right person and right person for your projects, it can actually be a real big challenge for you in the growth and the scaling of your business. So it's really, really important that you've not managed that well properly. Thirdly, again, as you're dealing with personalities and different people, you're also dealing with their challenges as well. So all of a sudden, they may have some life challenges. They may have lost their job. They may be in the middle of a divorce, or a spouse has passed away, or whatever the situation is. Because you're now involving other people, their challenges that may be happening within their lives could also now become your challenges, because they are maybe knocking on the door and saying, "Hey, Mr. Ponte, I'm going to need that money back because I just lost my job." Well, that becomes a little bit of a challenge as well. So and those tend to be some of the largest ones. And the other part that is also a big challenge is because of the responsibility that you have in your acquisition. It is truly, truly important that you keep the lines of communication with your money partner open and sharing. I always say this, the good, the bad, the uglies. It's important to kind of communicate this stuff because you do have that responsibility. It's not always fun when you've got to share a little bit of bad news. And so that is also part of the responsibility that comes along with this. So with that being said, just the important part and some of the biggest challenges is personalities, managing their expectations. You have to also understand that you be challenged with their challenges as well. So you are dealing with different people. And last but not least is because you're dealing with different people, you've got a bigger responsibility, and you truly need to make this and turn this into a business because that's what you are actually doing. So,
Want to succeed in real estate investing? Focus on networking and building a strong power team. As an investor-focused realtor in Edmonton, I can connect you with local events and experts. Plus, keep you in the loop with exclusive deals. Contact me below to start growing your network and your net worth today. Let's get back to it. It's almost like screening a tenant. You could get a tenant in there and that's all good and well, but the screening makes the whole journey a whole lot different. So you should be screening your potential partners as well. And when it comes to selecting a partner to partner up with, could you touch on some key factors to consider?
yeah, like I guess just like anything, I always treat joint venture partners as like part of a team member. And I shared this in presentations in past as well. It's like when you're looking for a joint venture partner, you are looking very similar to like somebody that is part of your real estate investment team, be it a realtor, be it a property manager, but probably even more important. And so for me, obviously the ability to obviously have the capital to finance the deal, those are obviously extremely important. But one of the bigger pieces is, are your goals aligned with this other person as well? Do you have very common goals in regards to what your objectives are versus theirs? Do you have very similar goals? And when I say that is, your money partner may only want to be in an investment for a year, but you are looking at doing an investment for 5 years. Well, that's not really kind of a common goal, and you may not be meeting their expectations and vice versa the other way around. So you can kind of do this right away, and it may not be the right person to be working with. Also understanding what their expectations are in regards to return. So when they tell you, "Hey, I'm Mike, I'm looking for a 25% return on my investment per annum," I have to be honest and say, can I actually facilitate that and be real? And more often than not, I'm going to say no to that. So I always try to manage realistic expectations. And I always like to kind of budget below. I always like to under promise and over deliver from my end. But if I have somebody that has really, really, really high expectations on returns, that may not be the right fit, because I have to be honest and say that may not be the right person for me, because I don't know if I'm going to be able to accomplish what they're looking for. And I don't want them to be disappointed in working with me. And I think the last but not least, and one of the biggest ones, is it is personality. It is about, do I feel comfortable working with this person I always get the spider senses. Like, when you got the heebie jeebies when you talk to somebody, if you've got kind of heebie jeebies talking to this person, you got to really ask yourself, do I really want to work with this person for the next 3 to 5 years? And I kind of use the analogy of, um, for those that are maybe single, you can probably relate with this. For those that have been married or have a spouse, I'm going to bring you back to your single days and kind of remember when you were kind of going on that date, maybe your very first date. And then you kind of get that sense if it's going to work or not. It's kind of the same feeling. It's just like, do I really want to be married with this person for the next 3, 4, 5 years? Can I see a relationship with this person? And that's really, really important, because once you get over that part, then it's kind of identifying some of the other things that come along with this is, can they qualify for the mortgage? Do they have the capital needed there? Can I work with them? What's their personality type? So those are just a few kind of key ones to kind of really enforce. But for you guys that are looking to raise money, there's one thing I can kind of reference, and based on this particular question, is absolutely screen your money partners. They're screening you to determine if they can trust you as a real estate expert before giving them your money, for them giving you money. But you should be doing the same thing in return and ask the person, can I actually work with this person for the next 3, 4, 5 years? Is this the type of personality I'm looking for? Is this the right individual? Do we have common goals? So those are kind of a few things already that, that just kind of stick out and are really, really important. And it's one of those things that I do every time I'm meeting new individuals. And there's sometimes they aren't the right fit. They aren't. And you know what? We just kind of say, you know what? I wish you all the best. And, if it's not me, maybe I need to talk to somebody else, but no harm done. So.
Yes. I love the way you broke that down. It's making sure your goals align, and then it's expectations, right? And then, of course,
Totally.
personality, making sure you guys click. And I mean, up to this point, so we've highlighted the benefits of partnering up so that you can scale. We've also highlighted challenges that you could possibly face and how to go about selecting a partner. So someone who's on board with this saying, yes, this checks all the boxes. I know I need to do this. But how do I go about finding these potential partners? What advice do you have for them on that?
Oh, that's a great question. And it's not an easy answer, but at the same time, it is an actual easy answer. And the first thing people need to understand is money partners are everywhere. I tell my students this constantly, is they are everywhere. They are, at the barbecue that you're going to be attending this coming weekend. They are at your kid's hockey game, and they are part of one of the members of your team. They are at your church. They are at the bingo hall. Money partners are literally everywhere. And I think the important part that I can kind of relate to people is, you want to make sure that you are talking about real estate investing. You want to share with them what you're doing and highlight that and intrigue them. I always kind of reference dangle the carrot. And what that means is you're communicating what you do. And so one of the things I teach my students is, you guys are all real estate investors. Present yourself as that. And so what that means is you're kind of elevator pitch. I'm sure you've heard this before, El Ray, right? It's just like, what's your elevator pitch? So if you're at a barbecue, one of these common questions they're going to ask you, hi, my name is this. What do you do for a living, right? You also do that introduction. It's nice to meet you, Mike. What do you do? What do you do for a living? Well, you shouldn't be actually sharing kind of what you do as, well, I'm a UPS driver or whatever the situation is. Present yourself as a real estate investor, and I acquire single family, multifamily properties in Calgary. Okay. Leave it there. Shut up. Don't say anything more. And they'll say, you do what? Well, I'm a real estate investor that buys single family and multifamily properties in Calgary. I raise capital from other people that are wanting to invest in real estate, and I manage that on their behalf. I don't need to do any selling, and I actually encourage don't sell. It's just about sharing. Let people know what you do, and it just naturally occurs and interest automatically happens. So anytime you can kind of create some dialogue, let people know what you are doing, who you are. And the big thing that I share with a lot of my students is, people want to get a chance to know you. You are investing in yourself. People are investing in you, not your deal. And so they want to know, are you a trustworthy person? Yes or no. So you as an individual need to be communicating that out there, is sharing a little bit about your journey. So be it on social media, be it on meetups, whatever the circumstances is, barbecues, share what you do. Let people know what you do. And you'll be surprised how people start to kind of really catch interest in what you do and maybe wanting to participate. When I started years ago, and, and I was telling my friends, and again, I had no idea about joint venturing at all, like not a clue. And I was telling people that I bought my fourth investment property. They were just, their jaw dropped. Now, in our real estate investing community, that may not sound like a lot, but in the general public, 4 investment properties is significant. And when you are saying something like that, they are mind blown, and they've caught interest, and now they're just like, what, you did what? And now they want to be part of what you are doing. And this is where that whole situation comes available to potentially partner with them. And they can be friends and family to begin with. The more dialogue you have with people in general that learn about what you do, they will start to catch interest in you. Okay. And I know for a lot of real estate investors, real estate experts, I like to call them, they have a hard time trying to find these people. So I challenge you guys, are you guys, the location that you're trying to find these people, are they the right locations? If you're trying to find money partners in a social media platform where there is nothing but real estate investors of like you trying to raise money from the same small pool, well, maybe you need to go to a different pool. Maybe you need to look at a different place to find those people. That's something I shared with you, El Rey, at a previous presentation, is start thinking outside the box, do some different places, think about who your ideal investor is and go to them. Like for me, my ideal investor are doctors and dentists and chiropractors. So you know what? I'm happy to go to their Facebook group and share a little bit about me. Okay. And all of a sudden I am the only real estate investor in those groups. Everybody else is talking about dentistry and all that stuff, but I'm the only real estate investor within that group that I can connect, network with, and I have no competition in there. Okay. So those are some suggestions, but honestly, real estate investors money partners are literally everywhere. I have met and partnered with people from my son's hockey games, hockey practices, barbecues, meetups. You want to be available. You want to be able to communicate. You want to share about what you do. And the more you share, the more you pique people's interest. And then from that point, you can start having some dialogue of potential partnerships. So
I feel like you could just do a mic drop there. That in itself is super powerful. We could end the episode here, honestly. You dropped so many bombs there. So, so like the first one, I love that, is that mental shift, because I feel like, and this leads to my next question, but I feel like a lot of investors also, they find a deal and now they're desperate to try and find that partner to make it work. And you're trying to find people in a state of desperation, and that just doesn't work well. So I love that, is just be who you are, be able to articulate what it is that you do, and the right people will be interested, and you could sort of go in from there. And then also I love that advice, because a lot of people are looking for money partners in the investor community, and there's a lot of competition. Everyone in there is an investor, but going to a different group and being the only investor there, I feel like that should be a no-brainer, right? Now, when people think partnerships, they generally think 50-50 split. How do you structure a fair and profitable partnership agreement?
Well, that's actually a really tough question, because every deal is a little bit different. So I've got different structures depending on the deal in itself. And so this is my belief, is I don't always have the same structure, because every deal is going to be very, very different. So even when I talk with partners, I may communicate them on a 50-50 split. Maybe it's a 65-40. Sorry, I'm calculating that wrong. Maybe it's a 65-35% split, where I charge a big acquisition fee up front. So for me, it's about making sure that, and again, this is going to sound a little bit weird, but as a real estate expert, and I'm hoping this is your audience, El Rey, that's paying attention to this, is you got to remember what you got into this first and foremost. Why did you get into this real estate investing game as real estate experts? What am I doing? What's the objective? What's the why at the very end? And it could be multiple different things. I want to have more free time. I want to spend more time with my family. I want to travel more. And so by understanding that first and foremost, now you're kind of building a plan to kind of accomplish that. And usually that plan is in regards to, well, I need to be able to create some capital, some money, some cash flow, some income to get to that particular why. So I push all my real estate investors that are listening in here, just don't forget that. That's got to be the premise first. And what is it that I want to get out of this deal? What is this deal? What's the opportunity in this deal first and foremost, the big picture, before money partners or anything? What's the opportunity? Then the second part comes to it is, what do I, as a real estate expert, want out of this deal? What's those returns that I want to get? What's the cash flow I want to get? What's the acquisition fee? What's the percentage I want to get out of this deal? Okay. So by understanding that first and foremost, then the second part becomes a little bit easier. And it's just like, is there still enough meat on the bone for my money partners where they are going to want to invest with me? Okay. And so what were their expectations? So if their expectations was 10% return per annum, does this deal be able to fulfill that? And so kind of creating that structure and that split that's going to be beneficial for both sides and satisfy what those needs are equally. That doesn't mean that the structure that you have on the one deal has to be the same for your next deal. I actually have quite a different variations of deals because I know what I want to get out of it first. And this may sound a little bit unusual for a lot of people, but I'm trying to get you guys to think a little bit differently. Just because 50-50 split is what's being shared about there as a very common structure doesn't mean that's the only structure that's available. Okay. So for me, I actually don't do a lot of 50-50 splits. I don't. And so for me, it's a higher percent. I got a percentage from an equity perspective. I also charge an acquisition fee because I spend a lot of time and energy scrutinizing deals. So what that means is I get paid up front for finding the deal. And again, that's a whole session in itself, Ray. So I'm not going to go into too much detail about this, but I think, the premise that I want to communicate with your listeners is find a structure that is going to work for you first. Start with you because this is your business. And when I say that is you got into this for a reason to accomplish your why. And I see a lot of investors, what they do is they start to settle. They reduce their splits. They reduce their cash flow. They want to satisfy their money partners, which is extremely important. Don't get me wrong. And I'm not knocking that, but they tend to lose sight of what they were trying to do out of this deal to get them closer to their why. And so because they've shaved off all of their equity or their cash flow or all that stuff, now they're tending to work for a lot less than they were hoping for. They're putting all this energy and effort and work, but they're just not getting the bang out of the best bang out of that either for themselves. It's kind of going to the money partner side. So I always challenge people, really look outside the box. In regards to your splits, look outside the box from cash flow. There are multitude of different structures and there's no wrong or right way to do it, but it does need to benefit you first and foremost. So even for myself, I do have 50-50 splits. I do. I don't like them. And when I say 50-50 splits, I did a lot of that in my early part of my career. And I still have those contracts today, but anything that is relatively new, I tend to give a little bit of a higher percentage to our money partners from an equity perspective. I tend to generate more cash flow for me and then at the same time charge acquisition and disposition fees. So, but again, every deal is very different. So when I even talk to my existing partners and they say, what's the deal structure? I kind of give them a general rule, a general guideline of what that would look like. And it's kind of similar to what I just shared with everybody. But I also do tell them, I go, it is really dependent on deal to deal. If I find a deal that is extremely, extremely profitable, I am going to take my pound of flesh out of it because this is my deal. And with that being said, as a money partner, if you want to participate and get a good return to satisfy what your goals are, this is what the structure is based on this particular deal. Okay. So I hope that answers your question, Ray, and it doesn't cause more confusion.
No.
But truthfully is I look at it deal by deal, and I disclose that to my partners constantly that every deal is slightly different. And my partners have the ability to say no or yes, that they want to participate on that particular deal based on their structure. There is no ill will if they say no to me on this deal. I will share another deal with them in the future. But for me, I look at the deal, make sure it's going to benefit me. And then equally as important is, will this also benefit my partners based on what their goals and expectations are from the investment as well?
I love that, honestly. And I think that also ties into the mentality from the advice you've given before is you're not coming from a point of desperation just to try and make it work, to try and find, pitch or sell to obtain another partner. It's more the state of, this is what I do. This is what I need to make this deal work. And then let's see if we can make the partnership work. Because I think coming from that state of desperation really shows. And even just while you're speaking about this, you could see the confidence. And I'm sure that really increases your turnover rate of people wanting to work with you, because you're confident
100%.
in yourself, you're confident in the numbers, your worth and your value and what you can bring to the deal. So therefore, it needs to work for you as well. One thing that I want to touch on, and this is actually what I wanted to ask based on the previous answer that you gave, was for people who haven't built up that database of money partners, they always have this chicken and the egg question is, do I find the deal and then get the partner and try and rush and get a partner in time? Do I find the partner and then eventually find the deal and bring the deal to them? But what's your take on that?
Yeah, it's a great one. And it's kind of going back to exactly what you were just saying about the desperation, which I wanted to get to the answer. So I'm going to tie it right into this perfectly. So, and it's a great question. And so, people may poo-poo on me and I'm totally fine with it. And that's okay. And it may have a different perspective. This is my perspective. And I've been doing this a long time. And I've known this by experience. I've worked with lots of students and I teach it in exactly the same fashion. Okay. It's kind of the chicken and egg. Is it the deal first or is it the money first? And my answer is it's always the money first. Always. And the reason why I say that is people try to get the deal. People make the comment is once you get the deal, the money will just naturally come. I think people don't understand what they're actually selling, to be very, very honest. Is people think they're selling the deal, but that's not what they're actually selling. What you are selling as a real estate expert, and you've probably heard this before, is yourself. Okay. People don't invest in deal. They invest in people. As if I'm going to give El Ray $500,000, the first question and the most important question I need to get answered by El Ray is El Ray going to take my money and go to Costa Rica with it and disappear? That's the honest, good truth of that. That's the first question that's in their mind. They may not even say that, because how do I say it? How do I ask El Ray? El Ray, are you going to take $500,000, go to Costa Rica? I'm never going to see you again. And you know what El Ray is going to, of course not, right? Everybody's going to say that. But that's what you need to overcome is you're selling trust. That's the real message for you guys listening is you are selling you, but really what you're selling is, can I trust El Ray with my money? Okay. So once El Ray is able to overcome that trust factor where I can say, you know what? I trust El Ray. Okay. I trust El Ray 100%. So just listen to what I just said. I trust El Ray 100% with my money. Then it doesn't really matter about the deal completely, because you know why? I trust El Ray 100%. So once you learn how to sell yourself, and I joke around, not physically, but you sell yourself mentally in regards to your approach, and you can have confidence in selling you and selling that you are a trustworthy person, that you're there to help support them, then the deal in a lot of ways is completely irrelevant. Yes, they still have to make a decision if they want to participate in the deal, but because they trust you, then you can really just, it's a relatively easier transition. And exactly like you said, El Ray, it's just like when you're in a position when you've acquired a property, and especially like in multifamily, like, multifamily is one of those things. As soon as you get that under contract, the clock's officially started, and you're thinking about 60-day terms or whatever the conditions are. the clock goes very, very quickly, even in single family, okay, with the conditions, be it 2 weeks or whatever. You want to spend your time doing due diligence on the property and the market or whatever the case may be. You don't want to be spending your time raising money during those very crucial time period. And so you should have all your money lined up in advance. Even myself, I got my database of people. Once I get a property under contract, I forward it off to them. I get calls, done. It's really, really simple because I did all the pre-selling earlier on without a deal because I knew what I was selling. I was selling me, and I had to convince them and share with them that they can trust me. And once they've said, yes, Mike, I trust you, and I'm signing the papers to say I'm interested in participating in your deals, then I have no desperation. I don't have any of these issues. I'm not making decisions on bringing in the wrong partners because I'm desperate for their money. And that's what I tend to see a lot is people have got this deal they need to close and they'll partner with anybody just to get the money. But then the pain comes after the fact, right? And exactly like I was sharing before when it comes to investment structures and everything like that I was just referencing earlier, is when you're in a situation of desperation because you need the money really quickly, now you may start making concessions just to get the deal done. And I've seen this before, is some people have made such significant concessions for the money partner, there was not a lot of meat on the bone for the individual that's now managing this. So they are technically managing this business, this real estate transaction for significantly less than they were hoping for. And it's just causing all sorts of pain points all over the place. Take the time to scrutinize your partners, find the money in advance. And I share this with my students all the time. I go, why are you looking at deals when you don't have any money? And I use this analogy, and I'm going to go probably a little long-winded on this one, but it's a good one, good example that I hopefully will resonate. But it's kind of like going shopping at Costco, knowing without a doubt that you left your wallet at home. Okay. So you know you left your wallet at home, but you pick up a shopping cart at Costco and you go around. You're filling the cart with, I don't know, ribs and cheese and paper towels. And you continue to go through that whole gamut for an hour, hour and a half. Okay. You fill that basket nice and full. Okay. And now you're going to go to the checkout and you leave. Okay. Because you can't buy anything because you have no money. It's the same premise. For a lot of investors, they feel like they're being action takers by finding deals, knowing that they don't have the money to do it. So they're spending their time focused on the wrong thing when they should be focusing on raising money before they start looking at deals. Okay. So for those that are listening, I hope this resonates well for people. And I know there's going to be a lot of people that say, Mike doesn't know what he's talking about, yada, yada, yada. But the truth is, and I've seen it again, over 21 years, the success that I've had in funding deals, finding deals, going through this process, simplicity is always have your money first. Get that aligned, ready to go. And it gives you a few different options. First of all, it helps you structure your deal properly. Secondly, you always have a pool of capital, always ready to jump in. And it also gives you a kind of a determination by understanding how much money you have, what types of deals you can be looking at. That's the best part, is once you know how much money you have raised, it gives you the ability to look at what types of projects I can participate in with. So again, long-winded, I apologize, but I'm passionate about this, and hopefully you see that, but is really about having the money first. It will simplify your life significantly, and you will close more deals by doing it that way.
It just logically makes sense. You can't buy anything without money, so why jump the gun on that? So honestly, from the beginning up until this point, we've gone through essentially the whole journey of how to find a partner, how to screen a partner, how to think about structuring the deal. Now, let's say they've done all of this, they've got their pool of partners, they've now started investing with them. How do they manage any conflicts or disagreements that may arise within the partnership? Let's say they've done everything right, but something still comes up. How do you advise people to manage those?
Oh, that's great. Really great question. And thank you for asking that, because a lot of people don't actually talk about this. Is really the after management when you've got a property secure. And situations can tend to happen. It does. Sometimes difference of opinions and things like that. And the first step, and one of the most important ones, is you definitely want to have an agreement in place, be it a joint venture agreement, other form of contract, whatever the structure is. you do want to have that signed just before you wrap up the closing of this deal. Okay. You want to make sure your partners already have this. It covers all the basis of this. And if you don't have a joint venture agreement, it is one of those things that is extremely important, that covers pretty much all major issues that possibly can arise. So talk to your real estate lawyer first and foremost to get one drafted up. Okay. Now, when I reference that, I always say that your joint venture agreement or whatever a contract that you have signed is your place of last resort. Okay. Where you actually have to reference that to get a dispute resolved. Okay. But the truth of the matter is conflicts can happen, but it can always be resolved with open dialogue and open communication. Most conflicts that I tend to see is lack of communication from real estate experts to money partners. And so the more you communicate, the better it's going to be. And that might even be some challenging times. And I think the important message I can relay to your investors or your listeners is this. Remember that the individual that is investing in you is your partner, okay? Your partner. And so sometimes things happen in our business. It happens to me probably, and it happens to me all the time. Like there's always surprises that tend to happen, be it a vacancy or whatever the situation is. I have to communicate that to my partner so they can be aware of what's happening. But it's important to communicate it, but you should also be coming to a point where you're trying to find solutions to those problems and coming up with some suggestions to help kind of present this to your partner, keep them informed that you are on top of it, that you're watching it. And then at the same time, as real estate experts, you're part of listening to a podcast like this with El Ray. Reach out to your community if you don't necessarily have your answers and get answers to help you support those decisions so you can present to your partners. But how to deal with a lot of this stuff. And I've been around the block a long time, so I've seen people come and go. But the biggest issue that I tend to see is people are just not communicating well with their money partners. And again, share the good, the bad, the ugly. They are your partners in this transaction. And the more you communicate, the better the relationship's going to be. And the more they're accepting that challenges will be part of this. And I think that the more you set the tone right from the very beginning of the discussion, even hiring them as money partners into your business, and inform them and say, hey, this is an investment, no different than anything else. Sometimes there'll be cash flow. Sometimes there won't because we have vacancies. It's just part of the business as well. We're going to work really, really hard to make sure that this is beneficial for both sides. So by setting the tone right from the beginning, don't put some over expectations to your money partners on what they're going to accomplish and achieve. Share the goods, the bads, the uglies. Also share some of the risks that are also part of this. Set the tone right from the beginning, so then it will help you manage that for the very long term. Again, most situations, most problems that occur is because of lack of communication. Always over communicate, and from a place of last resort. Okay. This is where you go back to your joint venture agreement, where you say, okay, well, since we don't both agree, let's go to the agreement, see what it says. And based on the agreement, that's kind of the decision that we proceed. Okay. So if you have to kind of go back to your joint venture agreement, you know that things aren't really going that great, but I still encourage you guys to have that as your absolute backup in case challenges tend to come. But can save so many relationships just by staying on top, overly constant communication with your money partners. So.
Absolutely. Like you highlighted, it's a partnership. And I think the key factor to any successful partnership is effective communication. Firstly, everyone watching and listening, I'll leave all of Mike's info below. Mike, this was really fun. I appreciate you sharing your valuable insights with everyone. And I definitely look forward to having you back.
Thank you again for the opportunity, guys. And I hope you guys enjoyed. All the best to everybody's investing journey.
Thank you for tuning in to Building Wealth Through Real Estate. If you're interested in building basement suites, then you definitely want to check out the interview with Varshit Patel. This is your host, El Ray Noble, signing off.